The remaining topics in Chapter 10 are contingencies, and then a little bit of a discussion of ratio analysis, or how to do an overall evaluation of liabilities. Contingencies are those things that are very likely to happen. They are potential liabilities. We have a past transaction or event, but really the value of it, the value of this liability, is going to depend on some future event happening. It's still likely to happen, it's probable, so we need to record a liability, but we understand that the value of the liability may not be as exact as some of the other liabilities we've talked about. The rules about liabilities in general say that if it's probable and we can estimate it, then we should record it, and we should record a loss for it. So an example of a contingency that comes up quite frequently for companies is when a company is involved in a lawsuit. So we have a company that's involved in a lawsuit, and it looks probable that the company will lose, and it looks also likely that the amount can be estimated, and we think the company will lose around $10 million as a result of this lawsuit. It could be the customer is suing us. It could be that we had a product that caused harm. An example that comes to mind is the production of cigarettes and the lawsuits that came about because of inadequate warning labels on cigarette sales. Well, in that case, there were numerous lawsuits, and there were payments which were made to states, in fact, from the producers of the cigarettes. So this was an example where a company was required or going to be paying an amount to settle a lawsuit. The lawyers estimated the likelihood of whether it was going to be settled and not in the favor of the company. The company was going to incur a loss. And they also estimated the amount. And so in this case, there had to be a recording of a loss, and there had to be a recording of a potential liability. And this came about at the time when the financial statements were prepared. So at the time the financial statements are being prepared, there's a general search of lawsuits to see what lawsuits exist against the company. There's a discussion with the legal team as to what the potential outcome will be. If it's probable that there will be a negative outcome, a negative reflection on the company, and then there's a need then, if this is all true, to record a legal expense or a loss associated with it. It's important to note here that there are legal expenses, and there are also losses, the amounts that have to be paid to other persons. Now, if it's just reasonably possible that something may come about, we don't have to record it. We do have to describe it. If it's a remote thing, something that's very unlikely to happen, then we don't even mention it anywhere. It has to be reasonably possible or probable for it to be included in the financial statements, and it's only recorded as a journal entry if it's probable. So there are all kinds of potential liabilities that can exist, whether it's a product that's manufactured in the wrong way. We have had a lot in the news about airbags recently, and this would be an issue where the lawyers would have to decide what they believe is likely to happen. And the company does, according to the rules about liabilities, if it's probable that there is a liability and you can estimate it, you do have to record something. And the offset to the payable is something that will affect us in our income statement. Ratio analysis, there's only two calculations that are really the prominent calculations involving liabilities. The first calculation is debt to asset ratio. So the assets of a company are supported by two numbers. Those numbers are liability or equity. This is in the accounting equation. Assets equal liabilities plus equity. And the question is, how much are the assets being supported by debt versus equity? And that's what the debt to asset ratio tells you. The other ratio is times interest earned. Now what does this tell you? It gives you an indication of the ability of the company to pay their interest, to make their interest payments. So these are two important ratios in liability analysis. So debt to assets is total liabilities over total assets, and times interest earned is EBIT. Earnings before interest and taxes divided by interest expense. Now, the way to get at earnings before interest and taxes is to take net income and then to add back interest expense and add back income tax expense. So you want to raise net income to get the number that would be for net income before you take out interest and taxes. And then you divide this whole thing by interest. And this will tell you the number of times that interest goes into EBIT. General Mills reported 14,560, that would million, so that's 14,560,000,000 of total liabilities and 22,660,000,000 of total assets. So their debt to asset ratio is 0.643. So the creditors have provided nearly 2/3 of the assets of General Mills, or nearly 2/3 of the assets of the company are supported by debt. This is a very troublesome amount. It is a lot of debt, because we know debt means that there will be interest, and debt means that there will be repayments. Stockholders' equity, on the other hand, there you don't have to worry so much about the repayments. We talk about contributed capital, and we don't have to worry about interest. Therefore, having such a high ratio of liabilities to assets is a bit troublesome. General Mills also reported net income of $1,855,000,000 and interest expense of $317 million, income tax expense of $741 million, and we need to calculate times interest earned. What this does is it gives us an indication of the company's ability to cover their interest payments. If you make enough in net income, which implies you have enough in cash flow, then you will be able to cover those interest payments. The interest payments are not going to be so great. In this case, to get at this number, which is net income before interest and taxes, you take net income, add back the interest, add back the taxes, and divide this by the interest, and you get 9.19. Another thing that's interesting about General Mills is its long-term debt note reported that there were loan covenants, there were agreements that said they had to have a minimum ratio of 2.5. Their ratio was 9.19. So their ratio is fine according to their loan covenants.